The question that continues to hover over Europe: will the debt crisis overwhelm the financial system and trigger a banking failure, effectively replaying the movie we saw here in 2008 when Lehman Brothers went bankrupt? Let's welcome somebody who knows a thing or two about Lehman. Until recently, he was CEO of the firm, or at the very least what was left of it during its restructuring. He's Bryan Marsal, co-founder and co-CEO of Alvarez and Marsal, joining us now for a Bloomberg exclusive. Bryan, good morning to you, and thank you for joining us here. Welcome.
Good morning.
So we know what happened. Let's start with this. We know what happened when Lehman went bankrupt. We all witnessed it. What if a major European bank goes down? What happens then?
I think the ECB will step in, and I think they've already decided that they're going to stabilize the banking system in Europe. I don't think the issue is so much will the banking system be stabilized, but what happens if there's a sovereign default.
What happens if there's a sovereign default? But what happens if there's a sovereign default? Could a sovereign default itself trigger a banking failure or multiple banking failures?
I think a sovereign default will trigger more assistance from the ECB, is what I think will happen.
So the ECB, in your mind, regardless, the ECB will find some kind of a policy mechanism to prevent, as I say, a replay of the movie that we witnessed in 2008. Nobody wants to run the risk of another Lehman Brothers?
The replay will be the same kind of a response that was made in the United States post-Lehman Brothers.
People say that the financial system is better prepared for a Lehman-type event than it was back in September of 2008. Do you buy that?
Well, the banks 3.5 years ago, they are significant versus 3.5 years ago, are significantly stronger today. I mean, there's significant improvement in their Tier 1 capital ratios.
Here or in Europe as well?
Well, in the United States. Significant amount of deleveraging has occurred in the United States, significant amount of liquidity improvement, better risk management, enterprise risk management. Over the last 3.5 years, the U.S. banks and many of the large European banks, Deutsche, Barclays, and others, have used this time wisely to strengthen their balance sheet. So I mean, it's a completely different picture today. But do I think that the banks continue to be too big to fail today? Yes. I don't think we have completely fixed that problem.
So would you say then that the lessons learned from the Lehman experience have not been successfully applied?
No, I think some of the lessons learned from Lehman are reflected in Dodd-Frank, but I think Dodd-Frank has not been fully implemented yet. So I'm not sure Dodd-Frank is the solution to the too big to fail, but I do believe that out of Dodd-Frank will come a redefining of what a bank looks like in the future. Will a bank be as complex as it is today? Will it be offering the services that it's offering today?
I want to get into that conversation, but let's hold off for a couple of minutes and stay with Europe right now, partly in light of the headline that we just got out of the EU that it's willing to consider a mechanism to recapitalize the European banks. At the end of the day, though, that just sticks the bill with the EU, not unlike the way the U.S. government stepped in here. It's a different situation, though, right? They have a union and a much looser union. It's not a proper fiscal union. It's a currency union. Is socializing the losses in Europe, in your mind, really going to work? And again, I'm trying to appeal to your knowledge as an expert on restructuring and the intricacies of the financial system, many of which you gain knowledge of in the past 3 years overseeing the Lehman restructuring.
Well, I don't think there's any question in Europe right today that there is a desire. The European powers are proud of the European Union. They intend to continue with that European Union. The only question in their minds is can they get their heads around a community of pain concept? The community of pain concept.
Explain to us what that means, community of pain.
Well, if you're going to have a successful restructuring, you have to have an acceptance of a community of pain concept. It means that the debtor, or the country in this case, has to accept a level of sacrifice or suffering in order to induce the creditor to go along with the transaction. At the same time, the creditor has to accept a level of pain or sacrifice. In this case, it would be the Germans or the Northern Europeans would have to accept a level of sacrifice. And I think both parties are jockeying around trying to figure out what that level of sacrifice is that they're willing to accept. I think they're going to find it. I mean, irrespective of whether Greece defaults or not, Europe is going to find that community of pain concept, and I think things will stabilize and be just as they were post-Lehman when the government stepped in and stabilized the financial system. I think the same thing is going to be repeated here. Whether Greece goes in or not, I think is really not the issue. I think that there will be a stabilization of Europe.
Are you surprised that the SEC was unable to find enough to get something to stick to the wall and be able to bring some kind of a civil charge against the people who ran that firm into the ground?
No.
Really?
No.
How come?
No, I wasn't, because I think if the SEC had found any wrongdoing, anything that would be criminal in nature, they would have. They did not find any. I did not find anything.
You didn't see anything that
no.
in your mind warranted.
I saw a lot of bad judgment. I did
Was
not
it just
see.
the ultimate in poor risk management?
It was the ultimate in poor risk management. Yes.
Then,
Poor liquidity management and poor enterprise risk management. Yes.
Then as we look at possible bank failures now out of Europe, how would you make a comparison? Because in Europe, if there is a bank failure that's caused by a sovereign default, let's say, where's going to be the dry powder to help this kind of bank?
The dry powder will be coming from the ECB, who will simply print euros, just like they did in the United States.
But isn't the ECB, couldn't that be a bit of a head fake? I mean, the ECB doesn't necessarily need to help out a specific bank within a specific country. In the U.S., it was much different. One country, those are our banks. The ECB, are they going to help out every specific bank within each country?
I believe the ECB considers step one, monetary union, step two, monetary and fiscal union. If you believe that, then the ECB is akin to the Federal Reserve, and the countries of Europe are akin to the states in the United States. I believe that's the way.
But there's not a massive cultural difference between the countries within Europe and the United States?
Oh, there's a cultural difference, but I think basically the Europeans are very proud of the EU. They want to be part of the EU, and I believe I believe that it's more complicated for them, but I think they're going in the same general direction.
They are, without a doubt, several steps behind the U.S. financial system. We recapitalized the banks here, first using the government, then using the public markets, and now we're trying to figure out what to do. Right? Congress passed the Dodd-Frank law. A few minutes ago, Bryan, you said that you didn't think Dodd-Frank was necessarily the right approach to a question that still hangs over the financial services industry here and over Wall Street. Are these banks too big to fail?
Well, I think Dodd-Frank was a step in the right direction. I think that there's lots of Dodd-Frank that I think is constructive and would have helped us pre-Lehman. At the same time, I'm not in favor of more regulation. I'm in favor of more effective regulation.
But what do these banks need to do? 5 years from now, 10 years from now, in the future, what do the largest U.S. financial services institutions look like? What do the biggest banks look like? Are they as bigger, maybe?
I don't think so. I think the banks will be less complex. I think they will be dummied down. I think that the consumer side of banking will become more of a financial utility, which has a lower risk, lower return.
Then what happens to all their structured businesses? Their businesses that are more liquid, but that yield more, make them more money?
Also afford a greater risk. Within those businesses is the primary concern, I think, of too big to fail.
Then how are these banks going to make money? I mean, Credit Suisse has become a significantly more conservative bank than others, and their stock price reflects it. They perform so poorly.
I think I think the banks have a serious problem right now as they look at their business model. Their business model pre-Lehman was too risky, and their business model today, if you lay out Dodd-Frank to its ultimate answer, that is probably the pendulum swinging too far the other direction. I think what you've got to understand is that the FDIC and the government are going to try and find a middle ground here. What risk is acceptable, and what business model works for the banks. And I think over the next 2 years, you're going to see that unfolding with the FDIC and the banks doing a wrestling match.
Bryan, give me your best guess. Over the next 5 years, do you think you will be restructuring another bank, whether it's here in the United States or in Europe?
I think we will be restructuring. I think we'll be in Europe working on non-core assets, a spin-off from a bank. So a bank will have core assets, which we will not be involved in, and non-core assets, which we will be involved in, yes.
All right. Bryan, good to see you, and please come back soon. Bryan Marsal.
Thank you.
He's the co-founder and co-CEO of turnaround and restructuring specialists Alvarez and Marsal. Just finished 3.5 years overseeing Lehman Brothers.